You are welcome to this channel. I want to wish you a happy and a prosperous 2025. I want to believe you are going to put in the effort necessary to acquire the knowledge that will make you a better and a successful investor. Let's look at this particular video. I want to consider the relationship between market sentiment and stock market bubble, the connection between market sentiment and stock market bubble. Market sentiment plays a crucial role in the formation, the growth, and the eventual bursting of the stock market bubbles. So here is how sentiment interact with the dynamics or the mechanisms of a typical bubble. Number one is exuberant sentiment drives market bubble. Exuberant sentiments drives market bubble. So in this context, I want to look at optimism and the issue of overvaluation. Optimism and overvaluation. During the early stages of a bubble, overly optimistic sentiments, can lead to excessive buying and rising stock prices, even when underlying fundamentals do not support such high valuations. So investors become, overly confident and believe prices will continue to rise indefinitely, which of course, prices don't rise to the sky. At a point in time, the market will then correct itself. So it equally incorporates hard behavior. So positive sentiments often fuels hard behavior, where investors follow the crowd, further pushing up prices. And this collective optimism leads to a self-reinforcing circle where more buying leads to higher prices, which in turn creates even more optimism. So we also want to consider speculation. Speculative behavior is often driven by bullish sentiments. Investors may buy stocks not based on company fundamentals, unfortunately, but on the belief that prices will continue to increase due to the prevailing positive sentiments in the markets. This speculative frenzy continues until a bubble is actually created. Number two is divergence from fundamentals. There's this unfortunate divergence from company fundamentals. So detachment from the reality. You observe a kind of detachment from reality. So in this case, you discover that as sentiment becomes overly optimistic, stock prices can become detached from the true financial health of the company, of companies, and even the overall economy. So while fundamentals may suggest the stock are overvalued, the prevailing sentiment can create a disconnect, leading to unsustainable price growth, wherever there is no actual connection between price movement and fundamentals. That particular sentiment will not continue for a long time. So we also want to look at belief in perpetual growth. There is belief that the market will keep on growing, perpetual growth. And during a bubble, sentiments can create a belief that the market or a specific sector will continue to grow at an unsustainable pace, leading to a kind of inflated valuation of stocks. So investors ignore traditional valuation metrics, relying instead on the expectation that price would keep on rising. And that's a mistake. Price will never rise forever. As we are all familiar with, it will certainly, course correct at a point in time. Number three is media and social influence on sentiment. media and social influence on sentiment. There's this prevalence of media hype. The media plays a significant role in shaping market sentiments. Positive news stories, kind of, it's kind of whenever the news is positive, it will ginger enthusiasm. Sometimes celebrity endorsements or coverage of rising stock prices can encourage more investors to enter the market, further inflating the bubble. So in this case, investors react to media feeds, and they tend to boost stock price up and up, again. So we look at social media amplification. Social media amplification in modern market platforms. In modern market, discover that platforms like Twitter, like Reddit, or financial blogs can rapidly spread positive sentiments, causing investors to pour into the markets, and then inflating stock price as a result. And so you discover that when this happens, there's that particular viral nature of information on social media, can really amplify, both optimism, and can equally amplify speculation, accelerating the bubble further. Please like this video and subscribe to this channel if you've not done that. Number 4 is signs of a bubble. What actually are the signs of a bubble? Number 1 is you will encounter extreme, bullish sentiments. Sentiments overall is bullish in the market. When sentiment become excessively positive and investors' confidence, reaches extreme levels, it can be a warning sign that a bubble may be forming. So common signs include irrational exuberance, rising asset prices without corresponding growth in earnings. You discover that asset prices will keep on rising, and there's no real growth in the underlying asset value. That shows that actually a bubble is forming. So not only did this widespread participation by inexperienced retail investors because of the issue of FOMO, and people, now investment is like democratized. Everybody can get a smartphone, download the relevant apps, create an account, and then discover that an inexperienced investor will point to the market. That shows that yes, a bubble is about to form, or is forming already, when inexperienced investors, jump into the markets. And we equally want to consider increased risk taking. People are now, taking risk at an increased level. So a sentiment becomes very bullish. Investors may, engage in riskier investment strategies, such as buying on margin. They borrow money to buy shares, taking on higher leverage, or speculating, and in more volatile stocks. You discover that there's this increased level of speculation, and this behavior can amplify the bubble and increase the risk of subsequent crash. Number 5 is busting of the bubble. The bubble will eventually burst. When it grows to a certain level, you discover that it will burst. So there's a shift in sentiments. Very important. There's this particular shift in sentiment and mindset. So when sentiment shifts from overly optimistic to fear or pessimism, a market bubble may burst. People shift from euphoria to fear to pessimism. That's indicative of the fact that the bubble is about to burst. And the change in sentiments can be triggered by a catalyst, such as disappointing, economic data, a corporate scandal, or an interest rate hike. Not only that, once the narrative shifts and investors start fearing losses, they begin selling of their positions, leading to a rapid decline in stock prices. Once the catalyst sets in, you discover that investors will react almost immediately. They start selling off their positions, and before you know what's happening, you discover that stocks will start, asset values will start plummeting. We start to plummet. So you also look at panic and capitulation. Panic and capitulation. As the bubble bursts, negative sentiments takes over, causing panic selling and capitulation. So investors who were previously euphoric may suddenly become fearful, accelerating the downturn of the attempt, you know, as they attempt to cut losses. So you discover that that particular shift would then lead to panic selling because the investors now want to mitigate their losses, want to cut their losses in whatever assets they've invested in. Number 6 is a role of market sentiments, post bubble. Role of market sentiments post bubble. So there's pre-bubble, there's post-bubble. So what actually, is the role of a market sentiment? So in this case, there's this particular, issue of restoring confidence. Confidence and restoring confidence in the market. So after a bubble burst, it can take time for sentiments to recover. So investors may become skeptical and risk averse, leading to a prolonged period of low confidence, in the market. This phase can create buying opportunities for a long-term investor who can assess the market based on fundamentals rather than sentiment-driven, hype. So you discover that when prices are low, because of the burst, actually, it's no longer, the bubble is no longer there. You could pick up, stocks of, solid, famous blue chip companies at a giveaway price. And so generally, there's this wealth transfer. Money, is made in a down market, not necessarily when prices are very high. So if you could pick all these stocks at a lower price, eventually when the market recovers, you discover that you stand to make an outsized returns at the end of the day.